And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it's Monday following the Thanksgiving break holiday. So I hope you had a very happy Thanksgiving. Glad you're back with us this morning. Lots of stuff to catch up with, of course. Over the weekend, we had the Omicron variant that is now hitting headlines. Of course, that also led to the market sell-off on Friday. You've got flash mobs robbing stores around the country. I mean, just all kinds of stuff to get into, to talk about. But hey, it's a new week as we get ready to wrap up the year. Importantly, we're wrapping up the month of November, and we're about to move into the first, couple of weeks of December. And again, as we've talked about over the last couple of weeks in particular, the market was really kind of showing some very weak breadth. Volatility was very suppressed, etc. And we suggested that markets were at risk of a bit of a correction. Of course, that occurred on Friday. Now, interestingly enough, everybody was kind of freaking out over the whole Omicron issue, and of course, this new variant of the virus. Turns out there's several articles out of the weekend that this virus isn't really any more contagious or really more destructive than the other variants are, and most likely the vaccines are going to work on it. So again, this is probably going to pass very quickly in terms of headline news. But on Friday, it triggered a very sharp sell-off in the markets. The markets had the biggest down day of the year. And of course, everybody points to the news story of the Omicron variant as the reason for the sell-off. And yes, that was the catalyst for the sell-off. Now, I want to be really clear about this. Over the last couple of weeks, we've been talking about the risk of a correction because the internal technicals of the markets were already set up for it. What it needed was some type of headline, and we've written about this a couple of times, saying that we needed something to change the sentiment of investors, and that was the news of the virus on Friday. Now, what happened, of course, is that there were very few traders around the markets. Markets were only open half a day. And so really it was pretty much the algorithms running the markets, all these robotic traders around the country. So as soon as there was a little bit of selling starting at the beginning of the morning, the robots kind of kicked in, the algorithms took over, and you got a lot more accelerated selling, of course, throughout the day. The market closed half the day, it was only open half a day, so around noon it closed, and markets were down about 2% or so, really kind of across the board. So a fairly sharp sell-off. We broke the 20-day moving average. And again, we were already on MACD sell signals. We were already on money flow sell signals. Those were all still in place, all suggesting that we should have some type of corrective activity, and that happened on Friday. Now, the question is, of course, is it over? That's the big question. No, and probably not here. Very likely we could see a bit of a rally today. Markets are kind of scheduled to open up this morning about 200 points on the Dow. S&P is going to be up about 0.5% or so, maybe a little bit more. So again, a little bit of a reflex rally from Friday's sell-off. Certainly not surprising, again, given the kind of the magnitude of the sell-off, seeing a bit of a reflex here. Of course, now the previous kind of support levels that we had in this kind of consolidation we've been in for the last couple of weeks is now going to be resistance. So once the markets kind of get back up to these previous levels that we were at previously, where markets were kind of finding some support, the 20-day moving average, etc., is all going to provide a bit of resistance here. So again, we're moving into the first 2 weeks of December. We still have mutual fund distributions to get into. So don't be surprised if we see a bit more sloppy action here over the next week or so. And again, it doesn't mean you're going to have a big correction, but probably we're going to have a bit more volatility here as we go through those mutual fund distributions as they get ready to distribute capital gains for the year. So now the good news is that as we've been stating, is that once we get through the next week or so, we'll be looking for an opportunity for the money flow indicator to kind of turn up positive here. We'd like to see our MACD signals actually begin to turn up as well. And if that occurs, that'll provide the entry point we're looking for to add some exposure for the end of the year Santa Claus rally. The first week or two of January also typically tend to be very positive as hedge funds, mutual funds, professional managers are getting allocated to the markets for the new year. Of course, as we get into 2022, all performance tables reset back to zero. So again, the initial input in the first 2 weeks of January will be portfolio managers getting positioned to try to participate with the markets and be in the right areas of the markets in 2022, particularly if they were suffering performance lag in 2021. So again, that's why the last week of December, first 2 weeks of January tend to be pretty good. So again, we want to be positioned for that, and so do you. So again, just kind of keep a watch what's going on here. Don't be surprised if you see a bit more weakness here over the next week or so. But that will provide that entry opportunity most likely. Now, of course, we can't dismiss what's going on with the virus. So again, there's a lot of things, what could go wrong here, right? What could cause the markets to sell off more? Markets are certainly very extended from long-term means, of course. We're very bullish this year. We've got a lot of excitement in markets. So again, what could kind of derail that? Of course, it could be the virus. Again, we're already starting to see countries begin going back into lockdowns, starting to talk about more lockdowns. Again, that's economic activity. Japan, as an example, locking down their borders from foreign travel. Well, Japan depends on tourism for a good bit of their economic growth. So again, once you start impacting your economic environment through lockdowns, well, that's going to potentially lead to weaker economic growth. Could we do that here in the United States? Absolutely. So, we've done it before. Will we do it again? I don't really expect so. The outcome of lockdowns in the U.S. was not good. And I don't think that's going to be something that we see people go back to very quickly, but it's a possibility. So again, we just have to keep a watch on these things. Don't entirely rule out, stupidity by politicians, over the virus. But again, you can't rule it out. So again, if you've got a lot of long equity exposure, something certainly worth keeping and paying attention to here over the next couple of weeks as we go through this. Again, highly suspect this will pass very quickly, and we'll be looking back on the Omicron variant as, something that came and went and didn't happen a lot. So, but we'll see. Again, you can't discount this thing entirely. We want to keep a watch on it. Now, some other things that are going on. We're wrapping up earnings season. Most of the earnings are now behind us. It was okay. Now watching on retail sales. Retail sales over the weekend. We had Black Friday last week, of course. Today is Cyber Monday. So you want to get out there and get all your good deals. But retail sales so far, now this is from Adobe and a couple of other trackers that track retail sales. Retail sales this year were better than they were in 2020, but lower than they were in 2019. Now, again, as in the midst of 2020, this was in the middle of the lockdown. And of course, we had just started opening back up the economy, getting money back to work in the economy, et cetera. So retail sales were good in 2020 because of all the stimulus checks, et cetera. So again, we look back on a comparison basis, 2020, we're about in line with 2020, not really doing a whole lot better, but less than we were doing in 2019. So again, there's a lot of expectation that retail sales for Black Friday and Cyber Monday were going to be kind of off the chart good. Not really the case here. And it looks like, and something we've talked about before here on the show, is that a lot of people were shopping early because of the shutdowns and the supply chain disruptions, etc. They were shopping early, and of course we saw last month some good retail sales, and potentially what that was dragging forward retail sales. And again, now as we get into December, we may see weaker retail sales heading into the year. So this is something to be paying attention to, because this will feed right back into personal consumption and GDP growth. More on this and other topics coming up right after the break. I'm your host, Lance Roberts, for the Real Investment Show, right here, realinvestmentadvice.com.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual lunch and learn on long-term care. December 9th at noon. RealInvestmentAdvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show. Of course, it is Monday, and we're back to it. So a couple of things that sounded funny over the weekend. My wife was out with my daughter, and they were out running around. And, of course, she's getting ready to go to school here soon, and she's been putting in a lot of extra hours working, particularly over the Thanksgiving holiday, to save up some extra cash because, college is coming up. And, it was interesting because she was out running around with her and she ran into a friend of hers that she used to run track with. And the mom was actually the track coach. And so my wife and her mom got to talking together, and the two girls kind of got off in the background somewhere, and they were talking about whatever they were talking about. Well, the one girl is talking to my daughter, and she kind of starts talking really loud, so that mom could actually kind of overhear the conversation. She goes, "Yeah, my parents aren't paying for any of my college." Hoping to get some sympathy from my daughter, who quickly piped back, "Yeah, neither are mine." So, sometimes conversations don't go as well as you hope. She was hoping to get some support. I'm sure the conversation has been in the household. Well, all of my friends' parents are paying for college. Yeah, we had that same conversation in our house, right? So now it was nice to see, two sympathetic individuals getting together. It's like, oh, your parents aren't paying for college either? No. And it was funny because the girl's mom said to my wife, and she looked at her, and then she goes, "You're not paying for college?" And my wife's like, "I'm not going broke." So she goes, "I'm trying to get moved to North Carolina." She's on her own. So, but we've talked about this on the show before, but it was interesting because, again, it's one of those things where, kids think that what they see on social media is the way it is everywhere. And, maybe it is in a lot of cases, in a lot of corners, but in reality, it's probably not. So she was very disappointed when she got home, by the way. So anyway, back to kind of the big work here. So again, this Omicron variant, of course, is, kind of the big headline news right now. It's kind of everywhere in the markets. And, the concern, of course, is, when it comes to the financial markets in particular and the economy, of course, is what does this mean? The first initial knee-jerk reaction is, oh my gosh, we're going to lock down the economy again. And the question is will we do that? And my suspicion is, and look, again, you can't discount what politicians will do because they don't always think logically about consequences. And a lot of and a big majority of the decisions that are made by politicians are done on a knee-jerk reaction. We don't have real thoughtful politicians that plan ahead and say, we need to do these things so that in the future we'll be prepared for these potential outcomes and events. So we don't have that type of political thinking. What we have is a group of individuals that run the country that simply react to consequences and emotions as they occur. And so that's what I'm saying. You can't fully discount the idea that the government may come out and say, we need to shut down the economy again because of this new variant. I doubt that's the case. Experience has taught us that lockdowns really aren't that good for the economy. It causes a lot of problems, causes economic recession. And the question becomes already, and is the ability to shut down the economy again, because you already have surging rates of inflation because of all the money that was injected into the economy at the time. We pulled forward a lot of consumption on whether it's durable goods or retail sales or whatever it was, and we've caused now this inflationary pressure in the economy and the disruption of the supply chain. So again, can you imagine if you shut down the economy again, what you're going to do to supply chains? There is some evidence that shutdowns of the economy are not really good. And then the other question becomes is, can the Fed actually provide enough liquidity to support another shutdown entirely? We don't know. The problem with all the liquidity injections is they have what's called an efficacy to them. In other words, the more that you do it, the less effect it has. It's kind of like doing drugs in a way. You've got to keep doing more and more drugs more and more often to get the same effect you had previously. It's the efficacy rate of that. So again, you see the same thing in monetary injections into the economy, which is often equated to crack. Because you've got to keep doing more of it to get the same relative effect. And so this is why we've seen each, as an example, since 2009, we've seen successive rounds of quantitative easing, and each round has had to be bigger than the previous round in order to get the same relative effect. So, will we shut down the economy? And probably not. I think the odds are extremely low of that. I won't discount them out entirely because, again, you never know what politicians will do. And there's certainly a bias with the current environment to make more exaggerated decisions, economically speaking, than probably are warranted based on survival rates, etc. But argument for a different day. But looking at this, again, the CDC announced over the weekend, no cases of it yet in the U.S. Of course, we're starting to see some cases in the U.K. and starting to spread out everywhere. So the question now becomes is, with countries already starting to move back towards lockdown, as we mentioned in the first segment, Japan's already kind of locking down. We'll see other countries begin to do this as well. Does this begin to impact global economic growth again? And what does that mean for markets that are extremely overvalued, extremely extended? That's the big question, right? And this is the one thing that we've talked about kind of repeatedly over the last year or so. There's certainly very clear evidence that the markets are in bubble territory, right? And how do you recognize a bubble? Well, you don't, unfortunately, until after it pops. Then everybody looks back and goes, oh yeah, that was obviously a bubble. But there's certainly some signs that we have bubble-like activity in the economy, record IPOs, record SPAC issuance, record speculation and options. I mean, these are the things that you see at the peak of a bubble-type environment in the markets where there's a disregard for risk. And so the question always becomes then, what is it that changes that environment? So what causes a bubble to pop is simply a change of psychology. That's it. To have the bubble, you have to have a psychology that is devoid of risk. And what I mean by that is that simply there's a complete disregard of risk. We often, often here on the show, we use poker or gambling as an example because that's really all investing is. It is gambling. And I don't mean that in a bad way, like, you're a gambler, you're addicted to it. And although there's some similarities to that. And, we have this very interesting idea as individuals that somehow magically we're investors and we're investing in companies because, we're Warren Buffett. We're not Warren Buffett. If you want to invest, if you want to be an investor, so to speak, then go invest money in a private company, a small business that you can own and operate and control the outcome of. That's being an investor. You're growing something very long term, you're investing in that, and it is a long-term prospect to generate wealth. If you're putting money into ethereal pieces of paper, hoping they go up in price with an average holding period of less than 6 months, you're a speculator. And there's nothing wrong with that. Don't be shocked or appalled that I'm calling you a speculator, because I'm a speculator. Anybody that invests in the markets is a speculator. None of us are investors because we have no control over what the companies do that we put money into. We are only buying pieces of paper hoping that I can sell them at a higher price to someone else. That is the pure and simple definition of speculation. Period. End of story. And there's nothing wrong with it. Just understand that you're not an investor and that you are a speculator, and trade accordingly. Manage risk. And as I said, we often use gambling as an example of this because gambling is the purest representation of speculation. You're simply betting on a hand of cards or dice or whatever your favorite game is, but you're gambling on an outcome and you're betting accordingly to the amount of risk that you're willing to take. In other words, how much money are you willing to lose on a pair of twos in a poker hand versus a full house, right? You're going to bet more on the full house than you are on the pair of twos because your odds of winning are higher and you instinctively know that, so you bet more. It's the same thing in the financial markets. But when we get into these bubble environments, we absolutely forget that there's a risk of loss because we stop losing money. Markets just go up every day. So what do you mean there's a risk? But when we get to a market that is completely devoid of risk thinking, that's what sets up the environment for that psychological shift back to risk. In other words, investors all of a sudden begin to worry about risk. There's a change in the speculative psychology of investors from a risk-on basis to a risk-off. And you saw that on Friday. And one thing that we've talked about before is that because of the very low levels of liquidity in the markets, in other words, for every action in the markets, there has to be a buyer and a seller. Right now, buyers are a lot lower in price, which causes these big gaps in the markets. Now, Friday was a very short day, very light trading, but it shows you where the buyers and the sellers are and that gap that's in between. So the risk is something happens with this virus or whatever else it is that changes the thinking of investors from risk on to risk off. That's the thing you want to be paying attention to. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual Lunch and Learn on long-term care. December 9th at noon. realinvestmentadvice.com.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN. RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I went to see the doctor. Really great guy, but he's an older guy, kind of like Coach Murphy that you grew up with in high school. And it never cost me more than $25 to go see him because his solution is pretty much the same every time. Rub some dirt on it and walk it off. And I said, well, don't you have something you maybe give me for the pain? He hands me a thing of Tic Tacs. He says, take one a day and pretend it doesn't hurt. What's your problem?
The Real Investment Show podcast. Same show, your schedule.
And it works just fine.
At realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows. Subscribe and bookmark our YouTube channel for The Real Investment Show. Or just click on the show links at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. I'm Rose Lance Roberts. Market's set to open up a little bit this morning. Futures are up about 33 points on the S&P, but fair value is a negative $4, so you're going to be opening about 28 points in the S&P. Now, that's down sharply from overnights where S&P was up about 60 points. So, again, after Friday's rout, looking to open up a little bit this morning, not surprising. As we were talking about in the opening segment, though, be a little careful here because we're about to move into mutual fund distributions, and that's going to put some additional selling pressure on the markets. And just in case you're not familiar with what's going on, just let me recap for you very quickly. Every year, mutual funds are required to issue out their capital gains, dividends, and interest. And this is why you're going to see a sharp drop in your mutual funds one morning. You're going to wake up and look at your account and see your mutual fund down $1, whatever it is. Don't panic, right? The fund didn't crash. That's the distribution. In a couple of days, it'll work itself all out. You'll either get more shares of your fund if you dividend reinvest, or you'll get cash in your account, one of the two. But those funds are going to have to sell stuff because right now, mutual funds have some of the lowest levels of cash on record. So they're going to have to sell some stuff in order to make those distributions. So we could see, and again, this isn't an absolute guarantee. I'm not absolutely telling you the markets are going to be sloppy over the next couple of weeks. I'm just saying that historically speaking, because of this requirement of mutual funds, that we could see some pressure on prices over the next couple weeks, so don't be surprised. Now, that'll set us up potentially for the seasonally strong ending of the year. So be looking for some opportunity to put some capital to work here and things that you've been looking at, right? One thing we talked about this past weekend is oil and energy stocks. Oil's had a very big correction here over the last couple of weeks because of the rise of the dollar as for one reason, but also too just because of what's been going on with the pressure from the administration on oil companies as well. Biden looking to now increase fees on offshore, onshore drilling companies for drilling leases. So more cost. One of the big problems has been that oil prices have been going up, $60, $70, $80 a barrel. That's increasing, price of gasoline at the pump. And, that's gotten the administration's attention, obviously, because that's inflationary pressures on voters. So the president has made some overt tones, of course, in trying to do things to fix the problem of high gas prices at the pump, such as charging the Department of Justice to investigate oil companies into potential price gouging. Oil companies don't set oil prices. He's also talked about and did release strategic petroleum reserves, which kind of a drop in the bucket for the amount of consumption that we've got going on right now between global supply and demand. OPEC Plus is not looking at increasing production. Why would they? They like high oil prices, so no real incentive for them to increase production. So this recent correction in oil prices may be a decent opportunity to start looking around and finding some good opportunities in the oil and gas sector and the energy sector in particular, because higher oil prices are likely to be with us for a little while. Now, I'm not saying indefinitely, but at least for a little while because of just the environment that we're in, the continued attacks kind of on production side, shutting down oil pipelines, increasing fees on oil companies, those type of things. Those are not going to encourage more drilling. And as we talked about in this past weekend's newsletter, which is on our website right now, there is one of the biggest disconnects right now between the amount of oil rigs that are out there producing versus the price of oil. Normally, when you have higher prices of oil, you see a big surge in rig counts as oil companies go out to drill more because of high oil prices. Makes sense, right? Oil prices are high. Why wouldn't I want to drill more, capture more of that business? But they're not doing that right now to a great degree, and we've got some of the largest disconnects right now between oil rigs and the price of oil that we've seen in some time. And normally that type of suppression leads to much higher oil prices, at least in the near term. So again, this recent correction back below 70, I'm not sure we're quite through that correction yet, but we are getting pretty oversold here. So again, don't run out and just put your entire portfolio into oil and gas stocks, but there may be an opportunity to pick up something of value at a bit of a discount. And relative to a lot of the other companies in the financial markets, whether it's tech or some discretionary stocks, et cetera, which have had huge runs over the course of the last year, there's actually some value. If we're talking about value versus growth, there's actually some value in the energy sector. So again, just something to maybe consider, something we're going to be looking at as well. But again, this recent correction we've had in oil prices, maybe an opportunistic kind of positioning as we head into the year. Just something to think about. Again, I kind of did a bit of a analysis on this past weekend's newsletter. So if you go by the website, realinvestmentadvice.com, and just click on the newsletter link at the top, it'll bring up the latest part of the newsletter. And we kind of go through the analysis on, where we are in prices and this recent correction. And by the way, this correction in oil price is something that we wrote about on October the 15th. Back in October, we wrote an article talking about the Commitment of Traders report. And, at that point, a lot of the speculation of traders that trade on oil prices were very long oil. And generally, when you have a large number of people kind of all on one side of the boat in terms of, expectations, something else tends to occur. And so we discussed this potential correction in oil prices back in October. So here we are. Now we're looking for the opportunity to take advantage of that. And again, this is why we do this analysis. And again, as investors, it's always kind of important to understand this, is that things don't just go straight up. And the mistake that most investors make is, when things are going up, it's like, oh, I've got to get in because it's going up. But if you wind up overpaying for something, not doing the homework, you're going to, wind up losing money on it. And it happens all the time. And one of the mistakes that investors often make is they see something going up, right? And oh, I'm missing out. I've got to get into it. So they buy it without doing any, homework on a technical basis or even a fundamental basis. They just buy it because it's going up in price. But you can buy something that is a good company or a good investment going up and still buy it at too high of a price. And even things that are going up longer term have corrections along the way. And so what happens for a lot of investors is they buy something and they buy it where it's already very deviated from long-term, averages and very overbought. And so it immediately almost loses money. And so they wind up selling it because it didn't work. And then the thing turns around and just starts going higher again. And this is why we talk about things from a technical perspective a lot. Because what technical analysis tells us is the psychology of the markets. And when things get too one-sided, you typically get some type of opportunity in the next, few weeks to the next month or so, where you can buy something at a bit cheaper, basis. I'll spit that out. So, and this is why we do that work. And here's an interesting sideline. I get this question quite a bit by email. Let's say something's trading at like $50. And, we'll look at it. We can look at it technically, and it's, 3 standard deviations above its 50-day moving average. It's extremely overbought. All the things that tell us that potentially it's not a good buy. And so we say, what? I would hold off on buying that here. And I get these emails quite a bit. And then the stock goes to 60. And I get the email back saying, well, you were wrong. Stock went to 60. Well, about that time, the stock then corrects back to 50. Now, when it corrects back to 50, now it's reversed all the technicals. It's now sitting on the 50-day moving average. It's reversed the previous extension. It's no longer overbought. It's oversold. But wait a minute. It's at the same price it was before. Yes. It's at the same price it was before, but now it's a better entry point than it was at 50 previously, because that reversal in price gave us a more opportunistic entry point where it's now holding support. It is oversold. Now it's got room to go higher. So just because you buy something at the same price doesn't mean the analysis was wrong. What it means is that it wasn't opportunistic to buy it at that time. It now is, because the internal variables have changed. And I know that's kind of a hard concept to pull across on the radio, but the point is simply this, is that it's important to do your homework if you're going to invest capital. And just because something's going up doesn't necessarily mean it's the right time to buy it. People buy stuff all the time that's going up, and they wind up overpaying for it. So always do a little bit of homework first before putting capital at risk. And just because you buy something at the same price it was previously doesn't mean it was a bad trade. Be right back after the break. Wrap up the show. I'm Real Science Roberts, realinvestmentadvice.com. That's realinvestmentadvice.com. Be right back.
Daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual Lunch and Learn on long-term care, December 9th at noon. realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. I'm Rose Lance Roberts. Very quiet today. You're very soft.
I'm resting up.
Very soft. So a couple of things here as we kind of get ready to wrap up the show. Interestingly enough, Social Security. I'm writing an article now. The latest Social Security Administration report recently out. And, you know, it's not getting any better. And so I'm writing a report kind of going back in history, looking at kind of where we are on Social Security. And it's interesting because we talk about the idea with Social Security is that we're just going to make a few tweaks and changes here. We can raise the retirement age to, 65, 67, 72, 912, whatever the number is. And, maybe we kind of adjust some benefits and we can raise Social Security taxes, and that'll fix the problem. Sounds logical, but we've done it before. In fact, we've done it multiple times throughout history. And each time that we've done these changes, raising the retirement age, increasing the Social Security tax, it never fixes the problem because the estimates are always wrong. Bad calculus, underestimating demand, whatever it is. One of the bigger problems, of course, is that we keep adding more and more beneficiaries to the rolls. Initially when Social Security was first put together back in 1935 under Roosevelt, it was just for people retiring and needed this kind of social welfare net. And there were 16 payers in for every person taking money out of Social Security at the time. So it was well funded, no problems. Of course, as politicians figured out that, giving away free money gets votes, they started coming up with more and more ideas to add people to the Social Security welfare rolls. So we added wives, and we added stay-at-home workers. We added, firemen and disabled people, and I mean just a plethora of individuals. In fact, any group that was thought to be underserved were added to the rolls. Railroads. They were added to the rolls of Social Security. Of course, as you add more and more people taking money out of Social Security, you need more and more people paying into Social Security, right? I mean, that just kind of makes sense. But the problem is twofold. One, you're adding people to the rolls faster than you're growing workers. So all these estimates that we have is like, well, if we just raise taxes on Social Security on the workers, then we'll have enough to meet the liabilities in the future. But we never do. A couple of reasons for that. Demographics. We talk about demography as destiny quite a bit here on the show because that is the one thing that you can mathematically calculate over time. You take the number of people that are being born and immigrating, and you can pretty much calculate down to the point of where they're going to die. And you can very quickly predict, based on that analysis, what your future payrolls are going to be, what your future tax collections are going to be, etc. Now, as I said, back in 1935, we had 16 people paying into Social Security for every person taking out of it. Today, it's barely above 2. Again, the reason is you're adding a lot more people to the beneficiary rolls, and you're not growing the population fast enough, either by natural birth or immigration, to offset the number of people you're adding into the pool. It's interesting, there was an article out over the weekend. This is really what kind of spurred my research and got me to working on this. A new study published by the Archives of Sexual Behavior was out and shows that Americans had a lot less sex in 2018 compared to 2009. Researchers from the Center of Sexual Health Promotion at Indiana University School of Public Health made the discovery by comparing data in 2009 and 2018 from participants of the National Survey of Sexual Health and Behavior. From the current analysis, lead author Dr. Debbie Herbenick and her colleagues examined the responses of 4,100 individuals from 2009 and 4,500 individuals from 2018, specifically focusing on how often they reported having sexual relationships. Now, they're talking about heterosexual, just to be clear, because heterosexual sex is what produces birth. Okay, so just making that clear. Right? Here's what they found out. The report found they found that while 24% of adults reported not having sex over the prior year in 2009, 28% reported not having intercourse over the prior year in 2018. So the number of people not having sex went up. Now, here's the interesting part. Why? Now, a couple of reasons. Now, the reasons for Americans not having as much sex as they were before is kind of a bit of speculation, but the speculation I thought was interesting because it kind of talks a lot about where we are in society, right? They note that compared to 2009, adolescents and younger adults are drinking less alcohol. Now, it's interesting because I have a lot of friends in the bar business. And one thing that they have bemoaned over the last few years is the impact of dating applications, things like Tinder and Match and others, where people no longer go to bars to meet people, right? Back in the day, we actually went to bars, hung out, had drinks, danced, whatever, and that's how we met other people. Nowadays, most of that happens, a lot of it happens on phone applications. Swipe left, swipe right. Brent's a constant swipe lefter for other people. Other reasons? Spending more time on social media and playing video games. In other words, people's relationships are online more than they are on in person. And, we've talked about this before, is that, a lot of individuals, they play video games online and they have entire friendships online of people they actually never meet. But they're very good friends with these people that they play with online, even though they've never met in real life. Same thing for social media. I've got 5,000 very close friends on social media. Never met one of them. Right? It's hard to have sex that way. Now, why is this important? Again, demography is destiny. If you take a look at fertility rates of Americans, we are now at the lowest level of fertility rates for women ever in history in the United States. Problem with that, of course, is that without fertility rates going up, you have a demographic problem, and all these estimates about securing Social Security, and we're just going to raise the age a little bit, and we're going to do this or do that, and that'll fix the problem, and that's going to make Social Security solvent. It's not true. Here's a number for you. 93 trillion. 93 trillion. The current debt in the United States, federal debt, is approaching 30 trillion. That's just the federal debt. 93 trillion is the unfunded liabilities of Social Security, Medicare, and Medicaid. That's what's got to be paid. Now, a lot of people in the financial industry say, "Oh, don't worry about it. You're not going to lose any of your Social Security benefits. It's fine. Don't worry about it. We'll just issue more debt. We'll have to issue $93 trillion in debt." That's today. Every year that will go up because you're adding more and more people to the rolls and you have less and less people paying in. And now we're adding more and more claimants to that role. Now we want to do paid leave, and we want to do paid medical care, and we want to do free college, and we want to do all these other things, right? It's got to be paid for. You can pay for it through higher taxes. Nobody wants to do that. So we're going to have to pay for it with debt. And the problem is that by paying more in debt for it, we continue to increase the interest expense, which takes more of the revenue that we have coming in from taxes just to pay the interest expense on the debt, and leaves less and less money to fund the other mandatory requirements of the budget. What are the other mandatory requirements of the budget, Lance? Could you tell us? Yes. That's Social Security, Medicare, Medicaid, prescription drug benefits, social welfare. That's the problem. The problem is that the Social Security problem is not fixable without increasing the population paying into it. That's a problem that we can't solve. Anyway, I've got a report coming on that out in the next week or so. So as soon as we get that up for you, I'll let you know. But we go through the entire analysis and tell you where we are and what the expectations are and how to fix it, right? That's all coming up in a report on Social Security. In the meantime, get by the website. Our latest report is out on the website talking about the Fed will cause the next crisis as they attempt to raise interest rates. That's on the website now. I'm your host, Lance Roberts, realinvestmentadvice.com. That's realinvestmentadvice.com. We'll see you tomorrow.
It's a rich man's world.